All right, let's take a look at a brief exercise on loan interest. And we've got a company here, Huddart, who has issued a 90-day 8% note payable. Very important that we understand that it says, now the way that's originally worded, it says that they gave a creditor a 90%, 8% note payable for $7,200. What does this mean? It means they got $7,200 and they're going to pay some interest on it. But I want you to focus on this word issued for just a moment. When you see the word issued or a company issues, anything like that, that's always the party that is receiving the money. So we can do this for short-term loans, long-term loans, the issuance of bonds, the issuance of stock. Usually if a company issues stock, then they get money out of that. Almost always, not always, but usually. Or they get some type of relief if it's a debt like a loan payable of some kind. Okay, so if you were to go borrow money from a bank to buy a house, it would be you, the borrower, who would issue the note to the bank. Yes, they supply all the paperwork, but you really need to remember that, because if you don't, you're going to mess up on your exams in your classes. Okay, so the party that issues, or issued in this case, the note, is the party that is receiving the money, and they are, in this case, going to be a debtor. Okay, now if they're issuing stock from a company, they would not be a debtor, but they are going to, in all cases, get either cash or some type of relief, and we'll leave it at that. Okay, so they issued this 90-day note, so it's due in 90 days, 8%, $7,200 on December the 16th. And it says, prepare the journal entry to record the year-end December 31st accounting adjustment that the company needs to make. So they need to recognize some interest, but how much? Well, we can take $7,200, which is our loan amount, and we can first multiply that by 8%. That'll give us $576. But this $576 is the amount of interest that we would pay for an entire year. In this case, we only have a period of 15 days. Okay, 15 days. And because 15 is less than 90, the way that we need to do this is a little bit tricky. We're going to multiply this amount by 15 divided by 360. Okay, and that's going to give us $24. Now, what is the 360? That is the number of days that we are going to use in the year. So it could be that if you're doing this, you have to use 365. I'm using 360 because it produces a nice even number. All right, so if this had just been 90 days somewhere in the middle of the year, it would have been 90 over 360. But this is a loan that we got towards the end of the year. We haven't paid any interest yet. It's not due until the end of 90 days. But we can accrue both interest expense, or we can record interest expense and accrue a liability as of the end of the year for $24. So we were going to have interest expense over on the income statement for $24. We're also going to have a credit for the liability amount, interest payable. I also want to stop here for just a moment. This is technically the correct way this is done. Interest payable is not always recorded. So just be aware of that. Sometimes we just simply don't do that. If you look at balance sheets, you don't always see interest payable, even if it is supposed to be recorded. So if it's for a small amount like this especially, that may not occur. All right, but this is correct. This is the way that we would do it. We're doing everything by the books, and so they want us to use some T accounts here. So interest payable, like all payables, has a normal credit balance. and credit is over on the right side, so we can just put this $24 here on the right side. Interest expense, as all expenses, has a normal debit balance, so we're going to put that figure over here, and I'm not really sure why we're going to all that trouble for the T account. It's pretty basic. And then they also want us to do something here. It says record the transaction from Part A in the financial statement template. So what this financial statements effect template does, and there are some other, sometimes we call this a tabular analysis or something like that, it's a way to kind of show us where we see an impact of the transaction. And so they've given us a list here, and depending on what your instructions are, it says use a negative amount when appropriate. So if the figure is bringing some type of account down, we're going to use a negative, and then we're going to use a positive if that account is going up. And so some of these we're not going to use. So what happened here? Was a cash asset affected? No, it was not. Cash was not impacted in any way, so we're going to leave it alone. Non-cash assets? No. No non-cash assets were affected. What about liabilities? Yes. Interest payable for $24, and so liabilities went up by $24, so I'm just going to enter it here as a positive figure. Contributed capital. What is contributed capital? This is money that investors put into the company, oftentimes by buying stock when the company issues stock and takes their money, right? So we don't have anything there. Earned capital. Well, we have interest expense up here, and this $24 is going to reduce net income in the other income and expense, gains and losses section of the income statement. So earned capital is going to go down by $24. Okay? Yeah. We don't have any impact on revenue here, but we do have, again, this expense, this interest expense of $24, and the expense is going up. So we're just going to enter the $24 as a positive number there. And then net income, well, if earned capital is a negative, net income also a negative. So not a whole lot to this, but it gives you a view of the journal entry, T accounts, although there wasn't a lot on there. And it also kind of shows you, hey, you know what? We've got a liability. We've got a reduction to our earned capital. We've got an expense that went up, and then our net income went down as well. So it gives us a little bit of a view of everything that takes place with this very, very basic scenario transaction. All right, that's it for this video.